Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. When researching for investment opportunities, we strategists follow two different approaches. One, a top-down approach, and the other, a bottom-up approach. On the one hand, the top-down approach starts at a bigger picture view or the macroeconomic view of the economy and sees all its components on a relative basis. On the other hand, the bottom-up approach takes a more micro view and starts with all individual components of the market and frames a broader market picture. There are times when the strategist might need to view a market both from the lenses of a top-down and a bottom-up to frame and confirm their thesis. After all, economy is not equity market. On this week's podcast, we assess the UAE equity market from both these points of view. But before that, it's important to take a stock of the performance of UAE equities in recent years. UAE equities as measured by MSCI UAE index rose circa 50% in total net return terms during 2021 and outperformed global equities by circa 31 percentage points. However, this outperformance came against a backdrop of a cumulative underperformance of circa 44% over the previous 2 years and 83% cumulative underperformance over the 6-year period to 2020. From a top-down perspective, UAE's economic growth is likely to accelerate this year. Strong growth in 2022 follows an outright contraction of the economic output in 2020 and a small expansion in 2021. Further, the gross domestic product growth rate is expected to slow in 2023 but remain higher compared to the long-term growth rate of the economy. It is worth noting that the growth acceleration this year is likely to be driven by a strong rebound in the hydrocarbon sector, which makes up circa 30% of the country's gross domestic product GDP. Non-hydrocarbon sector, which has expanded last year following a slump in 2020, is expected to grow this year and the next but with moderating gains. Purchasing Managers Index (PMI), a high-frequency soft measure of economic activity, continued to moderate from its local high reached in November but remains firmly in the expansion territory. Emirates' focus on developing its new economy and diversifying away further from the hydrocarbon sector must prove beneficial over the long term, while higher oil prices should certainly help in the near term. We all agree that the pandemic has highlighted the importance of digitalization over the long run, and UAE does very well on these measures already. UAE has made major progress on information communication technology (ICT) and development of its digital legal framework. The UAE is in the lead in most aspects of digitalization, including in e-commerce penetration and fintech. For instance, UAE ranks second in ICT adoption and fourth in digital legal framework as per a World Economic Forum survey. On the World Competitiveness Ranking 2021 done by IMD, UAE ranks 9th overall amongst 64 economies ranked. For comparison, US ranks 10th here. Also, the recent legal, social, business and financial market related reforms should help the ongoing momentum. This should in turn help equity market performance over the long run, especially as more new economy themes get listed on the stock exchanges, reflecting the underlying changes in the economy. However, when looking at the UAE market from a bottom-up perspective, one needs to temper their enthusiasm. As detailed earlier, the equities have performed strongly already over the past year. Higher correlation to commodity prices, especially oil, have helped UAE equities to a large extent. As US Treasury yields increased, the appeal for value style relative to the growth style intensified over the past months. UAE equity market, which traditionally traded on cheap valuations, benefited from this. However, following the recent strong outperformance, this relative value of the UAE equities has faded quite dramatically. For the context, at the time of recording this podcast, based on IBES consensus forecasts, both MSCI UAE Index and MSCI All Country World Index were trading on the same 12-month forward price earnings multiple. Most equity benchmarks for UAE remain heavily concentrated in a few individual stocks. For instance, the three sectors of financials, telecoms, and real estate together make up most of the index. This compromises diversification, especially at a time when both financials and telecom sectors in the UAE are trading at high valuations compared to their global peers. UAE stocks have lower return on equity despite strong net income margins as the asset turnover remains very low. Proposed corporate taxes could impact the net income margin too, albeit marginally. Positioning into UAE equities remains neutral with active allocations from both global and emerging market investors in aggregate remaining close to the long-term averages. Momentum for the UAE equity indices remains strong, helped by the enthusiasm surrounding the recent initial public offering activity in the country. In summary, while the top-down view of the UAE equity market looks appealing for the long run, the bottom-up view is not so enthusiastic. From the latter perspective, UAE equity market is expensive with heavy index concentration, faces balanced risks, but has has momentum. Thank you for listening. In case you like this podcast, please do share it with a friend or a colleague. For more information on what was discussed on this podcast and what all this means to your investments, please reach out to your contact at ADCB. You can also find a lot of investment-related content on our website at www.adcbam.com. Thank you once again, and this is Kishore Muktinutalapati signing off.